Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Bob Elliott, who's a former senior investment executive at Bridgewater Associates and currently co-founder, CEO, and CIO of Unlimited Funds. So, Bob, thanks for joining the podcast today.
Hey, thanks for having me. Really appreciate it.
You're welcome. And we definitely have a lot to talk about with what's happening in the market. So I guess my first question, I was recently heard you on another podcast. I think it's Lead Lag Review, which I really enjoyed. And there's something you were mentioning, which I found quite interesting. It's like, especially as sort of like a fund manager that you were, and I guess at the moment now, you sort of having to put positions in sort of months in advance to when you really think they're going to happen, oftentimes because of the size. So I guess from your opinion, what are you paying attention to at the moment that you think will happen in next 3, 6, 12 months?
Yeah, I mean, I think in many ways, what we're seeing in the world today is a pretty typical inflationary cycle. How we got to this inflationary cycle is a little unusual in terms of COVID and the various fiscal responses to COVID. But in those inflationary cycles, it's not uncommon to have a supply shock that extends those dynamics. With essentially the war, which I'm sure you appreciate sitting there in the UK, has exacerbated what was already a bit of an inflationary cycle. And so in that process, typically what you see is strong economic activity lead to stronger inflationary pressures, which then over time leads the central banks to tighten in response. We've gotten through some of that, but all things considered, there hasn't really been the sort of economic contraction necessary to bring down or ease labor markets, which typically is the core area that is driving an inflationary dynamic that's reinforcing. And so we're sort of halfway through, let's say, that cycle where we've already had the emergent inflation pressures and the tightening, but have yet to get the type of decline in economic conditions necessary to bring down inflation over time. And so, when you look out in that part of the cycle, bonds still are a bit challenging to hold given the inflationary dynamics and the plausible continued tightening. Equities, you would typically want to be underweight given that the forward-looking economic conditions are not so good. And it's always good to hold some commodities and gold in that situation because, central banks sometimes chicken out in terms of doing what's necessary to tighten, to slow economic conditions and fight inflation. And so you want to be prepared for that plausible outcome when you're positioned in your portfolio.
Yeah, it's really interesting. I guess, you mentioned that inflation, which is the key theme, I guess, for the past few years. And there's lots of talk, US inflation's gone down, but before we were talking about UK inflation's gone up 2% month over month, which is pretty crazy. And it seems like a lot of those are, I guess, the more ingrained parts of inflation. So I guess increasing wages, how, housing costs in some countries, etc. A lot of them seem like they're actually growing more than you'd expect. It's not as much the transitory effects. So do you see that as a bit of a concern?
Well, I think obviously depends on exactly which market you're talking about, though. Broadly, when you see an inflationary dynamic, typically what you see is the initial inflationary pressures are in things like goods prices and energy and food and commodity prices like that, because those are the areas that can become tightest when economic activity is strong, and also then are often the places that are most hit by supply shocks, which obviously because of the war and also, COVID first and then the war second, created a great deal of supply shocks along those dimensions. And so, I think typically you see that, and then what happens is as those prices rise, in an environment where the economic activity is relatively strong, which, it will probably get worse, but like European unemployment, pretty much at cyclical lows, UK unemployment, pretty much at cyclical lows. Every week I look at US claims data. The US economy, the US labor market is secularly strong. And so what happens is when those rising prices happen in a context of a tight labor market, that you almost always see you see individuals, negotiate for higher wages, either explicitly or implicitly, and that then creates higher nominal incomes, which then starts to reinforce the inflationary cycle. And that's essentially what we're seeing right now. Now, people often point and they say, hey, look, aren't real wages negative? Doesn't that mean that actually the inflationary pressure is easing? That's not right at all. Inflation is a nominal concept, and so easily people forget nominal concept, which means that if the nominal wage is rising, even if it's rising less than prices, even if real demand is actually negative, that doesn't necessarily mean that there isn't inflation, because what matters is the nominal price rise. And so what we're seeing is so classic right now in terms of prices are rising, and now we're seeing wages rise. And I just put out a panel of different charts across different European economies and the UK was also included in there, and the US as well. Like, that's basically what we're seeing, is that dynamic. And that's the thing that's very hard to break. So now the shock is not transitory. It has permeated the wages, the nominal wages. And once you permeate the nominal wages, you have to ease the labor market to then ease demand and ease prices.
Yeah. So is there any comparisons to this in the past? Has this happened before? Or?
Well, I think there's been a number of more or less extreme inflationary cycles that you see. In the sort of less extreme camp, you see dynamics like this even in the 2000 cycle or the late 90s, the late 80s cycle, where you had somewhat moderately tight economic conditions and a bit of commodity price pressure, and then you started to see inflation rise and it flow through to wages. And so those are sort of in many ways very typical macroeconomic business cycle dynamics, like very classic business cycle dynamics, which I think many of us have forgotten, because most of the business cycles we've been through are like COVID, which was not a business cycle, and 2008, which was really like a financial crisis, not a business cycle. But like boring old business cycles kind of look like this. Now, of course, you can look at more extreme cases, which I think are useful, not because they're representative of exactly what's going on right now, but I think they're representative of how the dynamics work and the linkages work in a more sort of explicit way, whether that's the US in the late 70s, whether that's frankly many emerging market crises. You could see that dynamic, which is that, for instance, in the emerging market crisis scenario, typically you see the currency fall, then you see domestic prices rise, then you see domestic wages rise, which then creates the reinforcement of the inflationary dynamic, the nominal inflationary dynamic. And so we're kind of having, across the developed world, a dynamic that's very similar to that, even though it's certainly by no means as extreme. I'm not trying to paint that picture, but the linkages and the dynamics are very similar to those sorts of cases.
Okay, but you'd say it'd be probably a bit too early to call whether we're going sort of one way or the other, I guess.
Well, I think the basic, the main question is basically, does the central bank do what's necessary to ease labor market conditions in order to ensure that you don't get a self-reinforcing process? And so we're sort of at the very beginning of what could be a self-reinforcing process. That's how I'd sort of describe it. And you look at if you took Jerome Powell for his word, you'd say the odds that we are getting to that self-reinforcing process are pretty low. If you take him for his word that he's going to do what it takes to break inflation. I think there are other places, particularly the EU, which I could talk about in more depth, but where you have, I think, a lot more hesitance to go ahead and tighten in the way that the Fed is tightening. And you also have political conditions around the central bank. I'm not talking about the federal government coordination. I'm talking about the central bank political conditions that may tilt towards running easier policy than would be desirable given macroeconomic conditions. And so, those are cases where the central, the ECB is behind the curve. There's no question about that. It's seeping into wages, and they're talking about, terminal interest rates like in the 2s when inflation's running at 10 and wage growth is starting to emerge in many of the major economies. Like, that's not a good path. That's a pretty bad path when we think about how you fight the inflationary cycle. It's quite different than the U.S., which is tight, on pace to tighten 500 basis points plus massive QT plus inflation has started to moderate a tad, and so those are two pretty different dynamics that are going on.
Yeah, and it seems like the markets have sort of thought that the Fed are going to pivot, and I guess, as you said, that would be very beneficial for Europe and the UK, because then they might not have to continue to chase the Fed to keep up.
Maybe, yeah. I mean, I think they're going to have to. I think they got a lot of work to do.
So you're not jumping on the pivot train yet.
No, not. I mean, I think the question, what I say is, there's a range of possibilities. It is possible. It's certainly plausible that the Fed ends up, pulling a Burns and running policy a little, easier than what's appropriate, given political, in response to political conditions. They're not totally apolitical entity, but it would not be prudent monetary policy. And so, my bet is that my thought would be that the more probable scenario is that Powell is going to run policy consistent with that. I think the story is totally different in Europe, because you have all of the member states in the Eurozone with essentially an equal vote. It's not precisely that, but it's essentially an equal vote in terms of running policy. And by definition, that typically advantages smaller, more peripheral countries that typically are more credit sensitive, and particularly it looks like that's what's going on right now. And so the odds that you end up getting a vote of the equal vote of all of those different players, the odds that you end up getting a much more dovish outcome are much higher in Europe than they are in the US, because in the US it's not like all the Fed governors vote for like their different regions. They vote essentially for the aggregate, and they're really directed by one person who is the head of the central bank, who really is determining by and large what policy is happening at any point in time.
If you look at the UK, the major concern will be if UK and Europe, if they're sort of more dovish, there's a potential that the euro will continue to devalue against the US dollar. Do you see that happening?
Yeah, I think it's a good question. We've obviously had quite a re-rating of the euro and sterling relative to the dollar over the course of the last couple months. I think in part what we're seeing is there was a significant pricing in of a massive energy crisis for the UK and Europe, which I think what we're seeing is like, it's not a good situation. It's not a good energy story for the UK and Europe. It's probably not quite as extreme as certainly market pricing would have indicated if you went back 3 months ago in terms of how energy was priced and gas and things like that, for energy and gas. And so I think we're kind of seeing a kind of an odd dynamic there, which is that they're basically unwinding a bit of extreme pricing, which has caused a pop in those various economies. Pop in the currencies, the sterling and the euro, which create a pop, I think probably to a level that's more consistent with the level of challenge that they're facing from an external perspective. But if what we find is that they end up running dovish on against rising inflationary conditions, I think that's sowing the seeds for a second leg down, because I think most folks have not positioned in a way to reflect the fact that Europe and the UK are going to run weak or soft relative to the inflationary pressures that they face. Now, I should also say there's some differences. Probably Europe is going to run much softer than the UK is going to run, just based upon the nature of the central banks and the political forces around them. So we may see even weaker conditions in the Eurozone, or even weaker euro setup than what we see for the UK.
Yeah, it all seems to, especially in Europe, it seems to link back to Italy, and I guess their high debts, and then the risk of their cost of borrowing increasing if interest rates go up, which would be very concerning for them.
Yeah. I mean, that is the challenge. It's like it's if the Fed had to manage monetary policy for a crummy crypto company, right? Like that's kind of probably Italians won't take that very well, but like it's as if you're running monetary policy for the weakest and the weakest kind of major industry that's going on in your economy, and that necessarily would mean running monetary policy that's far too easy for the rest of the economy, right? And so I think that's the challenge that the ECB really faces, is because stability, like interest rate stability and financial stability across the totality of the Eurozone is so important. And because there are still several profligate economies when it comes to maintaining their financial house and being reliant on external financing, that basically they're forced into position to manage policy against Italy's needs relative to managing policy against what would look like the needs of someone basically like France and Germany. And the main question basically comes, this will create a question that's very similar to the sorts of questions that emerged in 2012. The good thing about 2012 in terms of what the ECB faced was, in 2012 the Germans had a lot of financial exposures to the Italians and to Southern Europe, and so as they always say, your lending to me is your problem when it's big enough, right? So that sort of everyone in the Eurozone sort of tilted towards being okay with a dovish process or a dovish outcome, because the financial conditions in all the countries merited it, not just in Southern Europe. There's been a big unwind of the financial market linkages and the lending linkages between particularly the North and the South over the course of the last 10 years, which has mostly been filled by the ECB printing money. And so the question really becomes less of, the ECB is going to run money consistent with what Italy needs to ensure that Italian spreads don't blow out. That's how this is going to work in one form or another. There's no question about that. The main question becomes, will the Germans take it, and how bad will the domestic inflationary pressures be, and will they be comfortable with the type of domestic inflationary pressures that will necessarily emerge given that dynamic, and the macro dynamic, and then particularly running such easy monetary policy in response to the inflationary dynamics that are there.
Yeah, especially if Italy refused to cut back on electricity and the crisis got worse. I guess that's where it could come to that point.
Exactly. And that's a space I'm less familiar with, is the nuances of all the cross-border energy exporting and importing that goes on. But what I could say is it would obviously that could easily be another fault line that could create challenges in the Eurozone. Now, look, do I think that there's a high probability that Germany leaves and basically leaves a Southern Euro? I don't think I don't think it's a high probability by any means. I also don't think that anyone is seriously thinking about that problem in any way, shape, or form. And that in and of itself means that it is the sort of a black swan risk that could easily emerge. It's a low probability, incredibly disruptive event that could emerge if you had a series of conflicts and if you had a macroeconomic dynamic that was tough enough or unpalatable enough in Germany that Germany started to ask real questions about whether it made sense to be in the Eurozone. I think it's like a 10 or 15 or 20% probability, not a 50+% probability.
Yeah, it's interesting. So, we obviously talk about inflation most of the time. Are there any other macro trends that you're currently watching?
Well, I think the biggest global macro trend, now this is a bit more secular rather than cyclical. I think cyclically it's mostly a story about inflation and the response to inflation. I think on a more secular time frame, the global shift from integration to disintegration, I think, is a critical dynamic that has just started, really just getting off the ground, and one that I think probably people who are investing on a strategic time frame probably underappreciate and frankly have have a hard time totally quantifying all the ways in it will play out. For a long time, for like 20 or 30 years, basically the whole history of most people's professional investing careers, there's been a huge disinflationary force that's come from integrating supply chains, bringing, frankly, hundreds of millions of people from East Asia, from the farm to the factory, and creating a globally integrated financial market and production system. And when you get to a point, you basically have two big shifts that are happening there. One is that disinflationary force from the huge mobilization of underproductive labor supply is long gone. Like, cost of production in China is now competitive with like the southern US as an example, or the rural US. So that whole dynamic, which is a huge disinflationary force for a long time, basically has gone. And then you had a circumstance where you still at least had most efficient production supply chains that were relying on boats and stuff like that moving across the world. That is starting to unwind as well, and instead we're likely to see regional blocks that are organized around various supply chains, which makes, I think it's very interesting, like the strategic short of East Asia relative to the strategic long of Latin America, I think is quite a compelling story. I think many, I was at a lunch where some institutional investors were like, well, I would never put money into Brazil. You can hardly trust your money there. And what I said to them was, I think the BCB is handling their inflationary cycle a whole heck of a lot better than can be said pretty much everywhere in the developed world, right? These countries faced in Latin America in particular, faced a pretty tough set of years from the mid 2010s until relatively recently, and have gotten a lot of their house in order in many different ways, both for monetary policy, as well as other more strategic considerations. And so, could we see a much more meaningful integration, basically, in the North and South American hemispheres, and a pivot away from East Asia for U.S. and North American manufacturing? I think that could easily happen, and that is by and large not priced in. A lot of people haven't thought about that problem, and I think it is gonna shape, like on a 10 or 20 year time frame. That's going to shape the way the world's going to work, in the same way that the onboarding of East Asia shaped from 2000 to 2020.
Yeah, so rather than onshoring, I guess sort of nearshoring, or
Nearshoring, right?
Yeah.
Exactly. And then I think that there's a more subtle and frankly much further progression in the European context, where Europe has actually done a pretty good job bringing on the variety of Eastern and Southern European countries that have been sort of co-integrated into the broader European supply chain. And so in a lot of ways, actually, Europe is quite a ways ahead of the US. It's not exclusively, but they've already developed, European manufacturers have developed actually quite rich and deep linkages in the Eastern European context. And so probably less a formative experience into Europe, though, on the margin, if you're thinking about, do you create a plant in China for your production, or do you create it in, Poland or Hungary or elsewhere in the Eastern European context? Like, you would tilt towards that, assuming that you don't think that the war will spill over, which probably won't. And so, that I think provides a lot of, that also will create a shift in capital, Germany turning away from China and towards the Eastern European economies.
Yeah, it's really interesting, because I've sort of had similar thoughts, and I guess at the same time, you could look at the green sort of revolution. You could look at demographics, which is probably a bit more of a long-term concern in some of these countries. And you sort of add all these things together, and it seems like there could be the potential that, as you said, rather than deflationary, sort of going to get more inflationary due to the increase in these costs. So do you see something like that happening, where inflation could be maybe not where we are at the moment, but 4, 5, 6% for longer?
Yeah, I think all of these forces, I think many of these forces point towards a more inflationary dynamic. The disinflationary forces from the onboarding of East Asia, like it was in some ways so subtle and so persistent that we kind of forgot about it. But if you didn't have those dynamics, the U.S., Europe, UK ran inflation at about 2% for 25, 30 years, and we all didn't recognize that, like, actually what was happening was there was massive deflation in anything that the Chinese in particular were producing, but other East Asian economies, and that offset what was relatively substantial inflation in domestic service economies. So things like healthcare, things like tuition, education, all those sort of inefficient or low productivity service based sectors of the economy. We all sort of got used to, well, it's okay, those are rising faster, but I'm spending a lot less on goods, and so it works out that it's okay, and my aggregate purchasing power is okay. Well, basically what we're doing is we're reversing that goods dynamic meaningfully, but it's very hard to slow the sort of inflationary pressures that exist in the top part of that in terms of the service sector. And so there's really only there's basically a question of, like, are we going to run higher inflation that and then had persisted for the last 30 years? That's a plausible path. Or are central banks going to constrain money supply, credit, and demand enough to ensure that when you net it all out, inflation overall goes back to their 2% mandate? The jury's out, is what I'd say. I don't actually know. And I think from an investor's perspective, what that means is that you want to be positioned for either of those outcomes. Like, the way most investors are positioned is to oversimplify 60-40 stocks and bonds, both of which have massively benefited from 30 years of secular disinflation. When you look in the forward-looking picture, stocks and bonds are basically as bad as the worst assets you could hold in that sort of dynamic, in an inflationary dynamic. And so I think it's, now is the time to basically sit there and say, should we actually start holding assets that would benefit from more inflationary dynamics? Talking about commodities, talking about gold, those are important complements to what is currently a strategic portfolio, super focused on disinflationary, frankly, just disinflationary growth is what it was focused on.
Yeah, and do you see maybe a return to a bit more value investing? I guess, as you said, there's still room for equities, but it's most people are probably like very, very highly weighted in terms of the tech companies and the growth companies. Do you see there might be a shift?
Exactly, and I think growth companies are reliant on two important things, which is, one, they're not profitable, so they need liquidity. And we're going from a period of incredibly easy monetary conditions, the era of, incredibly cheap money, to the era of incredibly cheap money is over. It's not coming back anytime soon, and you shouldn't expect it. And so those tech companies are going to be particularly struggle, because what they need is that sort of constant flow of capital, cheap capital and borrowing. They also, because they're profitable maybe in the future rather than today, they're particularly sensitive to a rise in discount rates. And so you see the combination of those things, and you say, well, actually what I want companies that are, that have near-in cash flows rather than relying on future cash flow growth. And I want companies that are not particularly reliant on financing on a day-to-day basis to maintain their operations. And that's where, value is, that's the place to go. And we see it, part of what I do at Unlimited is we've developed technology that infers what hedge fund managers are doing and what kind of positions they have on. And it's interesting to see how positioned to value type sectors hedge fund managers are today, basically the most that they've been in the last 25 years, as a way of sort of playing defense, but I think also acknowledging these more cyclical and secular trends that really advantage value stocks relative to growth stocks, and are really betting on the sorts of outcomes that actually happened in the inflationary 70s period. And during that period, value stocks did great. right? They really navigated that environment very well. And most hedge fund managers today are basically making a bet on a similar type of dynamic by being overweight value relative to growth.
Yeah, and I guess what, in your opinion, what would sort of convince you that maybe that's not going to happen and we're just going to go back to pre-2020, back to normal, basically?
Well, I think there's always a question of whether there's some sort of supply shock, a beneficial supply shock that we hadn't anticipated, and whether that could create a situation that either whether it enhances productivity or reduces input costs. I think that's an interesting question, as where could those supply shocks exist more strategically. If we, as an example, if tomorrow we found trillions of barrels of oil or something under the sea, and it was cheap and easy to get out, well, then that would be a big deal in terms of a beneficial supply shock. I think more subtly or more simply, like, you could have a circumstance where, for whatever reason, the war resolves more quickly than current expectations, and the flow of oil and gas out of Russia just ends up being faster than is expected. I have no particular, to be clear, I have no view on what's likely to transpire. Certainly not relative to what market pricing is, or the collective wisdom of the market on it. So this isn't a bet or a guess in that direction. It's just it's a possible path that I think could help sustain set of conditions that look a lot more like the 2010s than what it's looked like over the last year, if we get that sort of supply shock. Also, China, if China sort of stopped this policy or sort of eased off on the policy of closing borders and things like that, I think it's a two-edged sword. It would increase demand, but it would also increase the probability that we wouldn't have to build parallel supply chains, which I think probably nets out to being a bit disinflationary over, probably short-term inflationary as their demand comes back online, probably over a 3 or 5 year time frame disinflationary. That's something that most people aren't really betting on to occur, but certainly could if she made that decision.
Yeah, it's really interesting. So I guess throughout our whole interview, we've been talking about probably how we're going to get to the point where, if you look at the last 10 years, passive has really been king. If you just put your money in a index fund, and then you basically outperform many active managers. So do you sort of see a shift occurring where that might not be the winning formula in the next 10 years potentially?
Yeah, it is. When everything's going up, it's easy to buy the index and feel good. And in particular, it's easy to it's easy to start talking about cost, as the fact that the indexes are low cost as your primary determinant, because you're getting what you need otherwise. And I think what we've seen over the course of the last year really is that active management can be much more effective at navigating through challenging market conditions than simply holding passive indexes. As I mentioned, we track the positions of hedge funds, and one of our products is a diversified hedge fund index, that replication that is intended to track the gross of fees returns of the hedge fund industry. And what we see in their positioning is that they've been able to navigate through this dynamic actually pretty well. A hedge fund industry returns, they have a little bit of beta in them. They're down 4 gross of fees over the course of the year. That frankly, most investors would take down 4 any day of the week compared to what they've suffered through this year. And it's basically the best asset class other than a concentrated position in commodities that you could have invested in. And so I think that really speaks to the fact that these managers and sophisticated asset managers, they know how to navigate through these market dynamics. I think the key question for most investors is this question of how much are you paying for it? because, once you put in all the fees, it isn't necessarily that great a deal to have active management. And I think there's going to be a bit of a reckoning in the same way there's going to be a bit of a reckoning around just purely buying passive asset classes. I think there's going to be a reckoning, say, over the next couple of years, 3 to 5 years, where there's going to be a real hard look at what sort of value are active managers providing. Were they just levered beta, or are they actually providing unique differentiated alpha? And what value they're providing relative to the fees that you're paying. And I think that's going to be a real question for a lot of investors. But on the surface, their strategies, diversified, hedge fund strategies, are going to do much better than index investing on a 3 to 5 year time frame, I suspect.
Yeah, it's really interesting. Bob, thanks so much for your time today. I really appreciate it.
Yeah, it was great being here. Thanks for having me.
Yeah, you're welcome. And my last question is, what is one message you want people to take away from our conversation?
Well, probably the biggest message I'd say is think about the different possibilities that could play out in the future, and don't be too concentrated in one particular outcome. And I think for most investors, what that means is look for diversifying assets to add to your portfolio, whether it's commodities, gold, inflation protected securities. Maybe add alpha to the extent that you can, and you have can find good products that do that. But this idea of just sort of relying on the same old 60-40 that we've been in over the course of the last 3 decades, and hoping that that's going to work out, I think it makes you underprepared for the range of plausible outcomes that could hit you over the course of the next 3 to 5 years.
Yeah, definitely makes sense. So, yep. Thanks again for your time. So if anyone wanted to find more about your work, where are the best places for that be?
Yeah, for sure. I mean, I'm very active on Twitter as just sort of a variety of macro thoughts, looking over my shoulder day to day. It's at Bob E Unlimited is where you can find me on Twitter. And then, of course, the company Unlimited can be found at unlimitedfunds.com. You can also check out our ETF, our newly launched ETF, which, as I mentioned, seeks to track the gross of fees returns of the hedge fund industry. That's HFND as the ticker, just like hedge fund HFND. So check it out. It's available to trade on all the major platforms that are out there.
Yeah, perfect. I'll put that on the description below. So, Bob, thanks again.
Thank you so much. It was great being here. Really enjoyed it.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.